Ladies and gentlemen, welcome to Principles of Accounting, Volume 1, Financial Accounting. This is Chapter 1, our first lecture. I'm Rita, your instructor, and today we are delving into the fascinating world of accounting. Now, it's often dubbed as the language of business. Why do we refer to accounting in such profound terms? Well, it's because accounting serves as a critical medium through which businesses communicate their financial health, performances, and strategic positioning to their stakeholders. Now, just as the language allows us to convey thoughts, ideas, and emotions, accounting enables businesses to articulate their financial narrative through structured financial statements, reports, and analysis. In other words, essentially, language allows you to talk about ideas, to talk about emotions, to share your thoughts. Accounting does the same things for businesses. It tells the business story, and it tells it through something called financial statements, through reports, and through analysis. Now, we say that accounting is the language of life. We extend the idea beyond the confines of corporate settings. So every individual, whether knowingly or unknowingly, engage in accounting activities in their daily lives, whether it's budgeting for monthly expenses, planning for retirement, or evaluating investment opportunities. The principles of accountings are in play. This intrinsic link so the link that's inside you between accounting and life, it really just underscores the how universally applicable it actually is and how it's necessary for everyone. So essentially, what we're saying is whether you recognize it or you don't recognize it, you actually use accounting in your day-to-day life. And so it's very important to understand that. Now, it's very important to understand both the financial and managerial accounting. And this is very, very important for anyone looking to thrive in today's business world. Financial accounting, what it does is that provides a snapshot of the company's past performance, its current financial position, primarily through something called a balance sheet, income statement, and cash flow statement. These are the three things that we really have to keep in the back of our minds. These tools are crucial for external stakeholders, so people like investors, creditors, and any regulatory bodies. So those who are making rules, right, regulations, who rely on them to make informed decisions. And so it's very important to master financial accounting principles because it will give you the ability to read, interpret, and analyze these statements and just enable you to access a company's uh, viability and strategic direction in a much easier way. On the other hand, we have managerial accounting. In managerial accounting, it focuses on the internal process and it's tailored to meet the company's needs for the company's management. So essentially, again, financial accounting is external and and managerial accounting is internal. Okay, so it goes internally. So that internal process looks at the details, or rather detailed analysis of cost, of revenue, and of performance metrics to aid in the planning, in the controlling, and in the decision making. When we look at managerial accounting, it's not bound by formal standards because it's internal, okay, which allows for greater flexibility and innovation in reporting. By understanding managerial accounting, what happens is that you gain understanding of cost behaviors, of budgeting, and performance evaluations, which is really critical for driving efficiency and effectiveness in organizations' operations. All right, so let's take a deeper look at the differences between these two. Accounting information serves as a diverse set of users. And here we're just categorizing them into internal stakeholders and external stakeholders. And so, who are the internal users of accounting? These are the people who are within the organization. So, you're looking at managers, executives, and employees who rely on accounting data to make their day to day operational and strategic decisions. They use budgets, cost analysis, and performance reports to reallocate resources or allocate, to begin with, to allocate or reallocate resources to control costs and to set targets. Let's look at an example. A production manager might compare actual costs to budgeted costs to identify where efficiencies can actually be improved. So that looks at what did we actually spend and how much did we budget for that spending and how can that efficiency between the two improve. That's what we're looking at. So really, internal users use benefits or they benefit from detailed and timely information that supports planning and control. External users, this is again financial accounting. So the first internal one is within the organization, that is managerial. The second one is financial accounting. And these are individuals or institutions outside the organizations who have a financial interest in its performance. So you're looking at investors, both, so investors, and that includes both existing shareholders and maybe potential investors as well. You want to use financial statements to assess the company's profitability, its growth, and potential and risk. They look at the metrics like earnings per share or return on equity to determine whether the company is actually generating acceptable income, or rather acceptable returns, sorry. Then they look at creditors, and lenders that also fall into this category of the people who are looking at financial statements or external users. And they analyze financial statements to evaluate the firm's liquidity, which means its ability to be sold quickly, and solvency before extending credits. So you're looking like ratios like current ratio or debt to ratio equity that really help the creditors gain the company's ability to meet its obligations. So these are the two. Sorry, I was on the wrong slide. Okay, so now let's look at the characteristics of financial accounting, and they really just emphasize the formal and structural nature of financial reporting. So financial accounting communicates performances through standardized financial statements. And by standardized, we mean the generally accepted accounting principles is one of them, and the Financial Accounting Standard Board, which we'll talk about in a minute. But these are standards that are put so that people can have, anytime you pick up a financial statement, any of the other ones as well, balance sheets and so forth, the statement of cash flow as well, all of them look the same across the board from any different place, which is why externally in financial accounting, this is very important. Now, these statements, what they do is they summarize the company's revenues, they summarize its expenses, assets, liability, and equity. And it provides a cohesive picture of the financial health. Because they are intended for a broad audience, these statements must be clear, they must be concise, and easily comparable across different companies and periods of time. Now, one defining characteristic of financial accounting is its reliance on historical data. Financial statements report what has already occurred during a fiscal period. Okay, so this is what we're looking at. Financial statements, what occurred in historical data, in a certain period. And now they record transactions when economic events take place. This historical focus, it provides a reliable foundation for evaluating trends and performance over time. However, it also means that financial accounting does not always capture emerging risks or opportunities. For example, Think of the value of a company's brand or technological innovation. That value may not appear on the balance sheet, even though these exist, because these are intangible assets, and those intangible assets they can actually uh, significantly affect the future performance. Now, we'll talk about all this a little bit later as well. Financial accounting in the US is governed by the generally accepted accounting principle, the GAAP. And this is a set of standards and procedures established by the FASB, which is a Financial Accounting Standard Board. And these ensure that the financial statements are consistent, comparable, and complete. Again, they look the same across the board so that whenever you grab a financial statement from any company, they look the same. Okay? Now, this standardization enables investors and regulators to compare companies and assess their financial performances. It's almost like an apples to apple. Because they look the same, you can do that. Now, modern businesses, they employ sophisticated accounting systems to record transactions and generate financial reports. So you're looking at things like QuickBooks, SAP, Oracle. They automate data entry, and that reduces error and facilitate real-time reporting. So in the past, before all the software stuff that you see, people would record them by hand. But now there's a difference, right? Now there are softwares that can actually help us do that, and that reduces the error. So again, we are continuing with the characteristics of managerial accounting as well. And in contrast to the financial accounting, managerial accounting is really just characterized by its flexibility and internal focus, as we said earlier. So, excuse me, managerial accounting, it actually does not operate under a comprehensive set of external standards. Instead, it provides information tailored to the specific need of the company's management. So, again, sorry, this includes detailed cost reports, budget forecasting, variance analysis, and performance dashboards. Because managers have to take decisions quickly and in response to changing environments, managerial accounting is really important, and it's usually generated a lot more frequently than financial statement can actually be than financial statement, which they can actually be adapted as needed. And this is for the managerial accounting information. One very important feature of managerial accounting is its inclusion of both the financial and non-financial information. For example, a manager might actually consider not only production costs, but also quality metrics, maybe customer satisfaction scores, or even employee turnover rates when evaluating a product line. So they're looking at a product line, they're not just looking at the monetary, right? The cost of productions. They're looking at the quality metrics. Is it good? Is it not? They're looking at the satisfaction scores. Are people actually are happy with this or not? So non-financial indicators, they actually provide insight into understanding the underlying drivers of financial performance, and they can signal future trends. What you're looking at is the why of the operations. So you're looking at integrating qualitative and quantitative data. And if you don't know what qualitative and quantitative means, qualitative has to deal with numbers. Quantitative is the quality of things, right? So these are qualitative is the quality of things. Quantitative is numbers. I don't know why I just mixed these two up. But to say it again, qualitative equals quality. So these are open-ended questions. So when you're looking at things like Yelp reviews, these reviews would be qualitative. The quantitative portions of that review would be the 5-star rating that someone may or may not have given this institution. Now, managerial accounting is inherently forward-looking. It may use historical data as its baseline, but its primary purpose is to aid in the planning and decision making. That's the whole purpose of it. So you're looking at budgeting exercises, for instances. You're looking at involve projecting revenues, expenses to ensure that the resources are allocated effectively, and so forth. Another one is scenario analysis and forecasting. And these are tools that help managers anticipate the financial impact of strategic decisions such as entering new markets and or investing in new equipment, because these reports are actually intended for internal use only. And so they can carry sensitive information with them and assumptions that would not be appropriate for public disclosure. Otherwise, people would know how the company runs. And you don't necessarily want that, right? You don't want people to be able to publicly copy everything that you have. Confidentiality is another distinguishing characteristic of managerial accounting. It's very important. So, the detail and the strategic nature of managerial reports mean that they often contain proprietary, there we go, information that could be valuable to competitors. And this is kind of what I was getting at a few minutes ago. You're looking at information that should not be shared. Otherwise, competitors can copy your strategies. So you want to, through managerial accounting, equip the company with tools to analyze costs, set prices, evaluate performances, and make informed decisions that drive the organization to success. This comparative table illustrates the major differences between the financial and managerial accounting across several dimensions. The first one considers the primary use. So, financial accounting serves external stakeholders, which is what we said earlier, whereas managerial accounting is internal. The second thing is the frequency and nature of reports, which is very, very important. Financial accounting reports are typically generated on a monthly basis, a quarterly basis, or annual, and even semi-annual basis, and they conform to standardized formats, as we mentioned earlier. Managerial accounting are produced as needed, so sometimes daily, sometimes real life, and the idea is to support operational decision making. So they serve two very different purposes. The third thing we're going to look at again is the frequency of reports, which is what we said. Then we have the fourth thing, which is the purpose of the report. So financial accounting summarizes historical performances to provide snapshot of the entirety of the entity's financial position and results of operations, whereas managerial accounting, on the other hand, focuses on planning and control. It is future oriented, and it uses historical data primarily as a baseline for forecasting and performance evaluation. Now, this forward-looking orientation is why managerial accounting often employs scenario analysis, and budgets to anticipate future conditions. Both of these have monetary reports or the nature of the report, whereas managerial accounting also includes non-monetary information. So things like production efficiency, customer satisfaction, and market shares. And lastly, financial accounting is subject to external audits and verification, whereas managerial accounting reports are generally reviewed internally. Now, in for-profit businesses, governmental entities, and nonprofit entities, there's a little bit of a difference. So organizations can be classified into those three categories based on the objective. So you have for-profit, you have governmental, and you have nonprofit. For-profit businesses operate within the goal of earning profits by selling goods and services. The profits they generate may be reinvested to support growth or distribute to owners and employees. Within the for-profit sectors, companies differ by their business model. So, for example, you've got manufacturing, you've got retail, you've got services. Each one has a different business model. And each of these area has a unique accounting consideration. Manufacturing businesses, for example, transform raw material into finished products through labor and production process. They incur costs such as direct material, direct labor, and manufacturing overhead. And they maintain inventories of raw materials. You're looking at work in progress and finished goods. This is what they keep track of. Retail businesses, they're also known as merchandising firms, and they purchase finished goods and suppliers and resell them to customers without altering them. Their cost, or their primary cost to say, are purchase price of inventory and expenses that are relating to storing, marketing, and selling. And that gives you the kind of differences between these. You can start to see the differences between manufacturing and retail, where accounting would differ, where you're looking at different costs, you're looking at different things that should be on the that should be considered when you are accounting. Governmental entities and not-for-profit organizations, so nonprofit, fall outside the traditional for-profit model. So governmental agencies use public funds to provide services such as education, public safety, and infrastructure. And this accounting system must ensure accountability and compliance with budgetary and legal requirements. And non-for-profit organizations, they pursue mission-driven goals, ranging from education to healthcare to social service, whatever it is, right? They rely heavily on donations, they rely on grants and membership dues to fund their activities. And so in this case, profitability is not their goal. These organizations still have to ensure that the inflow meets or exceeds the outflow to sustain operation. So they have to have good accounting principles. So if you look at these pictures, you can see that cars are different from one context to another. So cars can be in a manufacturing setting. So a car would represent the complex production process. The manufacturer acquires raw materials like steel, rubber, electronics, and transforms them into components and finished vehicles through labor and machinery. Accounting for manufacturing operation in this case would involve tracking the cost at each stage. So you're looking at tracking the raw materials to work in progress to finished goods and allocating overhead cost accurately to determine production costs and profitability. Now, in the retail context, the cars appear on a dealership lot, they're ready to be sold. The retailer's primary function is to bridge the gap between the manufacturer and the consumer. So retailer purchase finished vehicles from the manufacturers, add a markup to cover their cost and desired profit, and sell the cars to customers. They deal with inventory management and pricing strategies when they're looking at accounting, right? So they must track the cost of goods sold, manage inventory levels to avoid exceeding or excess stock, and they analyze sale data to make informed purchasing decision. And finally, in a service context like the taxi, the car could symbolize a rental or rideshare businesses like Uber and so forth. So here the focus shifts from selling goods to providing access to transportation services. So it becomes a service business that relies heavily on labor and often bears significant upfront costs for acquiring assets that generate revenue over time. Accounting for services here require careful attention to revenue recognition because revenue is typically earned when service is performed rather than when cash is received. And so additionally, cost accounting must account for the depreciation of vehicle and allocation of operating costs across service units. And so you can kind of see the differences of where it moves and how it moves. So now let's ask a quick question. Think of the last restaurant that you were in. Of these three business types, manufacturer, retailer, and service providers, how would you categorize the restaurant? Is it manufacturer, a retailer, a service provider, and can you think of examples of how a restaurant have characteristics of these three businesses? Well, very quickly, I hope you pause and you actually think about this, but very quickly, so sorry, it's all three. So the kitchen is like a manufacturing plant. Um, the um, the food selling portion is like it's like a retailer, and then the service provider is when they give you the food and they are servicing you essentially when you have a waiter come in. And so here you have to, in accounting, you'd have to account for all of these different areas of it. All right, so who are stakeholders? We talked about them before. Stakeholders are individuals or institutions that own equity in a corporation. So they provide capital, maybe upfront, in exchange to receive ownership stake that entitles them to a share of the profit and dividend and the right to vote on corporate matters. So these are people who are funding the company essentially. They kind of buy into it and then they own a portion of it and so forth. So now these shareholders do not directly manage the day to day operations. Their wealth is tied to the company's financial success, making them keen customers or consumers of financial statements. So the financial statements, they go to these shareholders or stakeholders, okay? They're known as both. Now, they want the financial statement, they look at earnings per shares, they look at dividend payout ratios, and return on equities that are metrics that guide the assessment of the management performance and influence the investment decision. Okay. Then you have creditors and lenders, and they provide resources in form of debt rather than equity. So instead of them owning a part of your company, they give you the money with usually with interest. Okay, so think of banks or bond holders and other lenders that expect payments of principal along with the interest. Their focus is less on profitability and more on the firm's ability to generate sufficient cash flow to service that debt, so to pay it back essentially. What they look for is liquidity ratio. So, how quickly can you sell certain things so that it becomes easy to manage? They're looking at cash flow statements and they leverage metrics that are critical to creditors' evaluation because debt holders rank ahead of shareholders in claim assets and even in liquidation. They are particularly sensitive to solvency and the quality of collateral. So it's very important to note these things as well. Now, both of them depend on high quality accounting information to reduce uncertainty and make rational choices. When you look at GAAP, the general accepted accounting principle, it helps ensure that the financial statements, again, are consistently prepared across companies and across time as well without any problems. So, in addition to investors and creditors, there is a variety of stakeholders that rely on accounting information. So, governmental and regulatory bodies such as Security Exchange Commission, the SEC, oversees public companies to protect investors and maintain fair market. The Financial Accounting Standard Board, the FASB, issues the gap for private companies, while Government Accounting Standard Board establishes accounting standards for states and local customers. Customers, though sometimes they're overlooked in this idea or in this scenario, they are increasingly attentive to the financial health of the companies they patronize. Okay, so now they're looking more at what's going on financially of these companies, especially the big ones. They follow them and they see, okay, well, where is this going? So large corporations depend on long-term supplier relationships and want assurance that vendors can fulfill orders over time. In some industries, customer review audit statements to evaluate their credit worthiness of vendor before signing contracts. So, public awareness about corporate social responsibility has grown. And so, consumers may examine the financial reports to gauge whether the company's spending aligns with stated environmental and social goals. So essentially, they're looking, hey, are they being environmentally friendly? Are they being kind? Are they doing the right things? Or are they just kind of consuming all that money? And then managers and employers form the internal portion of the firm, right? So financial accounting aims to serve external. Again, managerial accounting looks for internal decision making. All right, so ways in which an organization can raise funding. What are these things? On the one of the central strategic challenges for any organization is obtaining the resources it needs to operate and grow. The most fundamental source for financing is retained earnings. So, profits generated by selling goods and services that exceed the expenses. Okay, so retained earnings is how much earnings you have kept after the selling of the goods and services that you are hoping to have exceeded or have gone more. You gain more than you lost, essentially. So when a company reinvests profits in a business, it avoids interest costs and the illusion of ownership, but must generate the surplus in the first place. Okay, so retained earnings, to kind of break this down, I feel like I'm on the wrong slide. Let me see this. Mm. All right, so I lost track a little bit of where I was, but I think right here. So one of the most fundamental sources of financing is retained earnings. So you're looking at profit generated by selling goods and services that exceed expenses. I think that's where I was. And so when the company reinvests profits in the business, it avoids interest. We talked about this earlier. All right. So the profitable operation. Essentially, you can raise money by your sorry, that's where I was. I remember. All right, so my apologies. You can raise money by generating income from day-to-day activities of the business and then reinvesting them into the company. That is one way of of financing the company or raising capital. You can do it through borrowing money, through debt financing. So companies can take out bank loans, issue bonds, and obtain lines of credit. And that debt allows the firm to leverage a small amount of equity into a large pool of resources and can lower the weighted average cost of capital. Its interest expense is tax deductible and in a lot of jurisdictions, and that makes debt an attractive form of tax planning perspectives. Okay, now there is an excessive leverage increases. There's this that excessive leverage increases financial risk, so lenders expect regular interest payments regardless of economic condition and may impose restrictive covenants. And so essentially, if you're borrowing money, there's debt, you have to pay that regardless of what's going on. You can lose the company otherwise, or you can lose your assets or whatever. Okay. And then the last thing is equity financing, and that involves issuing shares to new or existing investors. So this approach bridges the permanent capital into the business without obligating the company to repay principal or pay interest. So essentially, you're using that as a leverage. Issuing stocks dilutes existing owners' stakes and may reduce earnings per share. So, investors who purchase equity expected a return in the form of dividends or capital gains and often exert influence through voting rights. Now, equity or equity markets reward companies with strong growth perspective and penalize those with inconsistent performance. We will talk about all this stuff more in depth, in depth. There we go later on. Okay. So, a successful accounting career actually begins with cultivating or personal traits that align with the professional demand. Accountants must be very detail oriented. A small error can actually have a significant consequence. They need analytical and problem solving skills to interpret financial information and to recommend courses of action. You want someone with strong ethical foundations because you're dealing with money and you want it to present it honestly and without bias. You want people with effective communication skills to be able to translate complex data into narratives that non specialists can actually understand. And the typical entry point into accounting profession is a bachelor's degree in accounting. That's essentially the education. So, undergraduate programs, they build foundational knowledge of financial reporting, managerial accounting, taxation, auditing, and business law. Students learn to record transactions, prepare financial statements, and apply the GAAP standards as well. And related careers, it's also transferable beyond just accounting. So, financial analyst, corporate controller, tax advisor, and a consultant draw on accounting knowledge to inform or to make decisions. And many business leaders actually include their chief financial officer and chief executive officers started their career in accounting. If you're an entrepreneur, you can benefit from understanding the cash flow, the profitability, and the cost structures by combining technical proficiency with strategic insight and communication abilities. Accounting professionals can actually build a diverse and reward careers. Okay, so the accounting field encompasses a broad area of specialization: auditing, taxation, financial accounting, consulting, information system, financial planning, managerial accounting, and entrepreneurship, as we were talking about earlier. Again, these are the same ones that we mentioned um, as well. All right. Public accounting firms offer services such as auditing, tax preparation, and consulting to clients across industries. The largest firm, often called the Big Four, serves multinational corporations and employs tens of thousands of professionals. Working in public accounting exposes accountants to a variety of clients and allows them to build broad expertise early in their career. Career progression can be rapid, but the environment is very, very demanding with long hours during busy seasons. And then public accounting provides foundation for auditing and tax that can be valuable in later roles. You also have corporation. They hire accountants to perform a range of internal functions. So corporate accounting prepares financial statement, manage internal reporting, analyze budget, and support strategic planning. They specialize in areas such as cost accounting, financial analysis, or internal audit. And large corporations often maintain financial departments staffed by controllers, treasurers, and chief financial officers who oversee the management and the risk. Governmental accounting involves working with federal, state, and local agencies. Accounting in this sector applies the standard issues by the Government Accounting Standard Board and handles fund accounting, grant management, and compliance with regulations. And lastly, you have nonprofit organizations that have a mission that differ from profit seeking entities, but they must still manage their resources effectively. So, accountants in this sector oversee donations, grant, and program expenses, making sure that the restricted funds are used in accordance with the donor's intent. And these are some of the certifications that you could get. You can get a certified public accountant, a CPA, and that is a credential that considers the gold standard in the United States for public accounting. Earning a CPA license requires completing a specific amount of education, usually 150 semester hours, It includes passing the uniform CPA examination and meeting experience requirement set by the state. The CPA are authorized to sign audit opinions and represent clients before the Internal Revenue Service, or known as the IRS. The Certified Management Accountant credential is administered by the Institute of Management Accounting. Accountants focuses on managerial accounting and financial management. So the CMA demonstrates proficiency in budgeting, cost management, internal control, and strategic analysis. The CMA exam covers planning, performance, and analysis and risk management. The next one is the CIA, and it specializes, which is the Certified Internal Auditor. They specialize in evaluating an organization's internal control and risk management process. This is offered by the Institute of Internal Auditors, and it requires passing comprehensive examination covering governance, risk, and internal auditing. And so they ensure that organizations operate efficiently and comply with laws and safeguard assets. And then the last one is the Certified Fraud Examiner, which is emphasizes detection and deterrence of fraud. And they are trained to investigate financial irregularities, gather evidence, and provide expert testimonies. And they work with the Internal Audit Department, forensic accounting firms, and law enforcement agencies. All right, my friends, that is it for today. Thank you so much for being with me in this lecture. If you have any questions, please let me know.